Then there are certain limitations on deduction. Mostly we have discussed, like uniform capitalization rule. So uniform capitalization rule is like for inventory, you can, so for inventory under uniform unicap, this in short is known as unicap rule. So under unicap you can include research and development cost, pre manufacturing cost and manufacturing cost as a part of your inventory. Instead of expensing them, you can capitalize them. And this unicap is not allowed for small businesses. So now it is $29 million. So not allowed for these people. They can take it as an expense or inventory. It's up to them. Then if there is any transaction between related taxpayers, so if there are two taxpayers who are related to each other, maybe parent and subsidiary or something like that, if there is, and they're reporting separately, then if any one person from the two are earning, that another person needs to report their expense in the year in which the one who is earned is showing. So both needs to be shown in the same year, right? Hence it will be automatically consolidated in the IRS directly. Business interest expense limitation, we have already discussed that 30% and 30% of ATI and business income and floor plan one. Then we have election to deduct business startup cost and organizational cost. Now business startup cost and organizational cost can be amortized up to 180 months. The rule is, if there is a startup cost or organizational cost, separately this rule is there that let's say, so let's take three scenarios or maybe two scenarios, no, three scenarios. So let's say the total startup cost is 10,000 in scenario 1, 52,000 in scenario 2 and 60,000 in scenario 3. Now how to take the amortization? The threshold limit for startup cost and organizational cost is $50,000. So if expense is below $50,000, then you don't have to worry about that. You can simply take for the first month you can take $5,000 out of this, and remaining 5,000 you can divide by 180 straight away, and that to start from the first month only, the amortization of the startup cost. So 5,000 divided by 180, 27. So in the first month you will take 5028, and in rest of the month you will start taking 27 till 180 months into 180. So this is the amount that you can claim as a startup cost in first year, right from the first month, right? If it is more than 50,000, then first 5,000 will start reducing. That means here if you see 2,000 is more than 50,000, right? So this 5,000 will be reduced by the excess amount. So now it will be 3,000, and remaining amount will be 52,000 minus 3,000, which is 49,000. So now this 3,000 plus 49,000 divided by 180 will start from the first month only and keeps on going for the 180 months. Now if we see 60,000, here whole 5,000 will be gone, because it is 10,000 excess than the 50,000, right? So if you subtract 5,000 minus 10,000, it will be in negative. So whole 60,000 you need to divide by 180, and it will start from the month of purchase, month of this cost. So this is a rule for startup and organizational cost. Then we have passive activity limitation. Passive activity limitation says that you can take the expenses up to the passive income only. You cannot adjust it with other kind of income, right? And if you have taken any credit, then you cannot take the deduction. So if you have taken for any specific cost, let's say you have taken energy efficient credit, then you cannot take energy efficient deduction. So either of the one you have to take. So these are certain limitations you need to keep in mind. Like you cannot take expense in two ways. Okay.